Hey everyone, and welcome back to the channel. Today, we're tackling a topic that often makes people's heads spin: deferred tax. It sounds complicated, I know, but I promise, by the end of this video, you'll get it. We're going to use some simple visuals to break it down, so stick with me. So, what on earth is deferred tax? Imagine you have two best friends, one is the taxman, and the other is your accountant. They both want to know how much profit your business made this year, but here's the catch: they calculate it differently. The taxman follows tax laws, and your accountant follows accounting standards. This difference is the key to understanding everything. Let's use an example. But then the taxman comes along and says, hold on. To encourage businesses to invest, our tax rules let you deduct a larger chunk of that cost up front. For instance, the tax rules might allow you to claim a $4,000 depreciation expense in the very first year. Now, let's look at the numbers. Let's say your revenue was $50,000. According to your accountant, your profit is $50,000 minus the $2,000 depreciation, which equals $48,000. This is the profit you show to your investors. But for tax purposes, your profit is $50,000 minus the $4,000 depreciation, which is $46,000. You see the difference? You're reporting a higher profit on your books, $48,000, than you are to the taxman, $46,000. Since you pay tax based on the lower profit figure, you'll pay less tax this year. Let's say the tax rate is 20%. The tax on your accounting profit would have been $9,600, but you only have to pay $9,200 right now. That's a $400 difference. This is where deferred tax comes in. That $400 you didn't pay this year isn't gone forever. It's just deferred. Postponed. The taxman knows you got a bigger deduction now, which means you'll get smaller deductions in the future. Over the 5-year life of the machine, the total depreciation will be $10,000 for both your accountant and the taxman. It's just a timing difference. So, your accountant needs to record this future tax payment. That $400 gets put on your balance sheet as a deferred tax liability. A liability is something you owe. It's basically your company saying, hey, we got a tax break now, but we know we'll have to pay that tax later. It keeps your financial statements accurate and prevents you from thinking you're richer than you actually are. Conversely, you can also have a deferred tax asset. This happens when you pay more tax now than what your accounting profit would suggest. For example, if a company has made a loss, it might not be able to get a tax refund immediately, but it can carry that loss forward to reduce taxes on future profits. This future tax saving is an asset. So, to recap, deferred tax arises because of timing differences between accounting rules and tax rules. When you pay less tax now than your books suggest you should, you create a deferred tax liability. When you pay more tax now, you create a deferred tax asset. It's all about making sure your financial reports give a true and fair view of your company's financial health over the long run. It's not a separate tax, it's just a bookkeeping entry to balance things out over time. Understanding this helps you read financial statements more intelligently and see the bigger picture. I hope this visual walkthrough made deferred tax a lot clearer. It's one of those concepts that's much simpler than its name suggests once you grasp the core idea of timing. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more simplified explanations of tricky business topics. Hit that notification bell so you won't miss our next video. Thanks for watching, and I'll see you in the next one.